Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so we're going to talk about this CoreLogic article because home prices are up. It's official. We have been tracking this. But what's interesting is that there's two cities that have outpaced in the last year the rest of the country. So the largest 50 metros, two of the cities have had the highest price appreciation year over year and since January. This is what we want you to do in the comments. We want you to guess. Wait, we're not going to get to it right away. Maybe 5-10 minutes in. So you got a couple minutes to think about it. Which two cities have had the highest appreciation since January year over year? Okay. All right. So here's the headline: U.S. CoreLogic S&P Case-Shiller Index annual growth regains speed again in August, up by 2.6%. This is an index, Juana. Index is different from median.
Right.
Explain to them how an index is different from median.
So an index uses a baseline, if you will, right? While the median actually uses the number in the middle. So, for example, we use an index when we're talking about how hot the market is, right? So that's what we do on Monday mornings when we do the Las Vegas market update. That's an index. So it's to some extent, the baseline is a made-up number, and then everything from that stems from that number to give you perspective.
And the reason why an index is better than median, like Wanda said, is the middle house. So the problem is, if you have a bunch of high-end homes that don't transact one year, and the next year it's all lower-end homes, the median drops. Because all that is what was the average house that sold, the median house that sold. Also, median home prices go up if actual home prices don't go up. It just there's more higher end transactions. So what they do is they index all the homes, and then they look at the actual change of actual homes, not the just the middle number. Okay, a good example was Vegas. Median home price was down 8.8% according to Redfin. But when it was indexed, it was only down 3%. Because what happened in Vegas was you had a lot of homes transacting, but they were all at the bottom end. So you had, if my fingers represent the normal sales, well, in the fall of 2022, they were all on the low end selling. So when you looked at the middle number, it looked like home prices had tanked, but it was smaller and homes transacting. Okay, here's the first big quote from the article. The non-seasonally adjusted month-over-month index posted 7th straight month of strong gains, up by 0.4% in August, a smaller increase than the one recorded the previous months, but slightly higher than the seasonal average of 0.3% recorded between 2015-20. So home prices rose more in 2023 seasonally adjusted than they did for 5 years, 2015 through 2019. It's actually 5 years, right? It's each of those years. Calculating monthly gains, home prices are up 6.4% from January of this year. Now remember, interest rates in the last 18 months have gone from 3 to almost 8%. Okay, so the theory that home prices would completely tank never happened. While monthly gains have been strong, the recent surge in mortgage rates suggests plateauing appreciation going forward. And then there's a figure, we're going to show you that.
Right. So stay tuned. We have lots of charts. Todd loves charts.
Okay, let's talk about this. Recent surge in mortgage rates, but we actually do, there's actually a theory that mortgage rates are probably going to start coming down pretty soon. And a lot of the forecasts for next spring are actually like even below 6.
Yeah, I think those are overly optimistic. But
Sue,
yes.
I think they are too. But do you think anything under 7 moves the needle significantly?
Yes, absolutely. And I think people are kind of wising up, Todd. I think people understand the real cost of money. So when inflation is 3 or 4% and you're paying 7% interest, well, then the real cost of money is that difference, right? So if inflation is 4% and you're paying 7% interest, then the cost of money is only 3%.
Right.
Because remember, when those people who got the 3% mortgages, well, what was inflation at the time? Not a whole lot. So that's what I'm talking about, the real cost of money.
Cost of money was basically 0.
Right.
Okay. Here's the chart. Now, this is a chart you've seen before. 2020 is the blue line, the gray line, and then that dark black line is 2022. Everything above the 0, this is not home prices. This is the year-over-year change. You could see the blue line. That's all of this year. and you could see that we were basically having kind of an average year, right? We weren't as good as 2021, but we were better than 2023 or 2022, and we were even better than the 2015 to 2019 average. That's the line right below it. So where it says August 23.4%, we're actually doing better now. In 2015 to 2019, home prices basically kind of zeroed out the rest of those years at the end of the year because that's what they do. Okay, so that's that chart. Now here we go. Did you guess the markets that had the highest? We're going to show you a chart here pretty soon. So off the top of your head, what markets do you think were the hottest in the last year? And because we're going to look at two things, year over year and then just this year.
So can I pick a couple of my favorite markets just because I like them?
Pick some favorite markets.
Okay. I like Vegas because I live in Vegas. Woohoo, Vegas. I think Miami's gotten a lot of attention and probably for some really very good reasons. And so I think, I would put my money on Miami.
Okay. Any other ones you want to pick? Don't say San Diego.
I wasn't going to.
It's relatively hot, but it's not one of the top ones.
But I think you're going to have maybe some other markets that maybe are not thought of as much.
Okay.
So maybe markets like Chicago because people are going back to the office. Maybe some other places on the East Coast.
Okay. All right, here we go. It's basically all Sunbelt.
Okay.
Southeast and West.
All right.
Miami was number one. Woohoo! Vegas was number two.
Woohoo!
So you got them.
I got those.
She didn't know, so she had to guess. Charlotte, Atlanta, and Phoenix showed reduced buoyancy in recent home price gains. Vegas, highest. Miami and Vegas were the highest year over year, and from the beginning of the year. Here is the chart.
Okay, so this goes along with what I always say. We're either at the very top or at the very bottom. We are not mediocre.
Okay. Miami and Vegas show large price increases compared with pre-pandemic pace in August. So you've got the pre-pandemic pace in blue. So if you look over at the light blue line, that's pre-pandemic. And then if you look at the dark blue line, that is just August year over year. San Francisco, now it looks bad. San Francisco was down 0.5%. And then, which isn't a lot, really. Cleveland, Dallas, Minneapolis, Portland, Washington. Chicago was basically even. Denver was kind of even. But if you go over here, look at all these. Okay, Tampa, that's Sunbelt. LA, Sunbelt. New York is not, but remember, people went back to New York. San Diego, which we know is hot because that's a market we follow. Boston, which is surprised me a little bit, but it's people going back into Boston. Phoenix, Atlanta, Charlotte, Detroit. Detroit's kind of a weird one, but Detroit, a lot of people left. It got hit pretty hard. And then Vegas and Miami were the two hottest markets compared to pre-pandemic. Now, some of this, though, okay, remember Vegas did have a little bit of pullback at the end of 2022.
Okay, so here's the thing to keep in mind about Vegas. Vegas is kind of Vegas is always an outlier, right? One of the reasons that we are outliers is because we have a lot of inbound migration. Now, what makes our inbound migration maybe different than other markets is that the people moving to Vegas come from places where they made a lot more money, and maybe, especially now with the remote work economy, they're continuing to make a lot more money. So statistics tell us that people moving to Vegas tend to make almost 40% more money than people already living in Vegas. So they're coming with money, which means that, the joke around here, which locals don't laugh at, is that, a local can't buy anything because Vegas is being bought up by the Californians.
Yeah.
So that's what we mean by that. So we have this inflow of people that are coming with money and that earn more money than locals earn.
Okay, here's the next chart. Now what this chart shows is 3 tiers. This is the home price tier. Okay, the dark blue on the left, and then is the low tier. The light blue is the medium tier, and the black is the high tier. And as you can look at all these cities and see, but we're just going to look at Vegas here. The high tier has had the highest appreciation. And Wanda, you see that every day because you're in the luxury market.
It's amazing to me. I've been in Las Vegas for a really long time, and the amount of homes that come across my desk that are in the 10 million and above range is just staggering to me. Just in the last month, I've had 2 that were 25 million.
Right.
So that's like, wow.
And one of them actually like sold pretty quick, right?
It sold like in the first week.
Okay.
With multiple offers.
But what's interesting is this shows the resilience. Now remember, Vegas, this high tier in Vegas has been driving the market. Mm-hmm. If you follow our market updates, you'll know this. The bottom and middle of the market in Vegas do not look exceptional. It looks like a normal market. If you had took out the top third of all homes and just showed the market, it would look like, people would be like, looked like it got a little hot, but not that bad. It was an upper tier. A bunch of high-end multi-million-dollar homes. These people coming from California that are not coming here to work in casinos. They come here with the company, or they come here, but their job is still in California. Mm-hmm. Okay, that's what you're saying. I just thought it was interesting. Look at these. Of course, San Francisco's negative. They have some problems with office space, and the city's being decimated. But Miami is strong pretty much across the board. That was interesting. Now, the one thing that got me here, just in the last couple days, 2 major developments happened regarding the overall economy. Okay. The Fed all of a sudden became very dovish. They're like, hey, we don't think we're going to have to raise rates. We think we're done. There's all this slowing we're starting to see. Inflation's super under control now. We're just going to let the economy kind of ease off a bit. Even though we had 4.9% growth, we're not projecting that in the fourth quarter, first quarter. So they think they're going to just kind of skim across. Mm-hmm. They actually said they believe it's the end of the tightening cycle, and that we're starting an economic. Stock market was up like 2%. A bunch of specific stocks were up like 20% in just a couple days.
Well, so the stock market being up was a confluence of several different things.
Right.
So that's a little deceiving. We're not going to put that just on the Fed.
But this is what's interesting. This is the 10-year Treasury. This is only the last 5 days. Okay. Now remember, the 10-year Treasury is basically mortgage interest rates, because this is the average amount of time. This is basically what is backed a mortgage bond. It's not 30 years, because people don't ever carry a mortgage 30 years. On average, they keep them about 10 years. So 10-year money is basically worth 30-year. Remember, 30-year is the amortization. Mm-hmm. It's the loan is amortized for 30 years, meaning for payments, okay? But the 10-year is really what drives it. 40 basis points in 3 days. Mm-hmm. 4.4%, the 10-year. Mortgage rates will follow. They just started dropping the last 2 days. Mm-hmm. And remember, this was just if you look here, it was basically getting close to 5%. Mm-hmm. And then, it was down to 4.5 almost. Mm-hmm. But it's sitting there at 4.574. This is it looks like we're seeing the light at the end of the tunnel for interest rates, but we still have a problem, low inventory. So home prices are going up. Mm-hmm. Now interest rates are dropping. Is it possible that we end up in this scenario where people next spring are going to say, where we have more competition, we have lower rates, so more people are jumping in. People still aren't selling because they still have the 3% rates and stuff. And we get back into this feeding frenzy, multiple offers, and people say, I should have bought last year, or I should have bought in the fall when there wasn't a ton of competition, because I could just refi, 6-8 months down the road.
Right. So I think that we will have more inventory in the spring for a number of reasons. First of all, because it's the way humans organize their brains and their lives. Mm-hmm. So I think we will have more inventory in the spring for that reason. The second reason is because sellers have been staying put for so long. It's going to be, the dam's going to break, so to speak, for certain people, and they're just going to put the house on the market because they need to get on with it. So that's another reason. And then lastly, I think that with even the prospect, we don't even have to have lower interest rates. We just have to have people believe that the interest rates will be lower. They will sell their homes because that's what they've been wanting to do for a while, but they've been sitting on them because of low interest rate. Even though they will have to buy something at a higher interest rate, if they believe that interest rates will be lower in the near future, they'll go ahead and bite the bullet, buy the house, and then know that they're going to refinance within a time frame that is acceptable to them.
There's nothing showing a housing crash. There's nothing showing a recession. There's nothing showing a bunch of job losses. Despite what you've heard, everything, the numbers show for themselves what's happened this year with housing. A lot of the home price appreciation was inflationary. Remember, we said this back in January. Go back to January of 2022. We said that these interest rate cycles generally last 18 months. And it turns out we're off by about 2 months, about 20 months, it looks like. Interest rates will probably start to fall. Home prices moderated. Just like we said, in some markets they were down, in some markets they were up. They were up in more markets than they were down because home prices year over year nationally never dropped. They have still been going up. We had some markets like Boise, Vegas, Austin, a couple places like that, where we had some year over year declines for a little, but we've made those back up because we're up 6.2% in Vegas just since January.
Right.
So what's the forecast, Juan? Tell them what to expect maybe, later this fall and the spring. What do you see happening? And I know you see all these luxury properties that make no sense. People are just dropping $25 million on a house, but.
Right. So, it's really interesting. I mean, obviously I spend a lot of time reading articles and listening to people far smarter than me, and then kind of try to make sense of it. And sometimes I read these articles or I listen to these really smart people talk, and I just see a disconnect between what I see and what they say. So, I mean, I've heard a lot of bearish people for next year, honestly. I've heard a lot of people have a very negative outlook about next year. I've heard a few people have a positive attitude about next year. Mine's actually pretty temperate, I would say.
Okay.
I think that next year is going to be kind of a do nothing, kind of like this year. I think it's going to be more of a return to normal, whatever that means. Okay. So what do I mean by return to normal? So I'm not going to cop out. I'm going to tell you what I think a return to normal is. I think a return to normal is an appreciation of 5%, give or take. So, anywhere between 4.5% to 5.5%, I think is fair game, somewhere in that neighborhood. I think that's what you're going to see for next year. That's generally what real estate has done. The long-term appreciation for real estate is about 4.7% a year. So, I'm not the smartest person on the planet in saying something that isn't based on fact. I don't see a whole lot of other things going on. Now, I'm going to put a caveat in there. There have been all kinds of strange things happening between the pandemic and the war in Ukraine and what's happening in the Middle East. And all these things, they do impact what happens here. I know that they're far away as far as these conflicts. I know they're far away, but they do impact what's happening here, not necessarily because of something material here, but because of the way people think about these things and how they weigh on their minds. So that's my take on it.
Okay. My take is, I don't know what's going to happen next year, but 5 to 10 years, I think we will look back on this and laugh that the people who didn't buy or whatever, because they wanted rates to go back to 3% or something, waiting for the crash. We just did the video 2019. Remember the housing crash prediction? We just did the video. It's been 4 years. Home prices are up 50%, and I had all this data proving housing crash.
There you go.
Yep.
All right. So long video. Sorry about that. Leave us your comments. Tell us what you think. What's your prediction? Put it in the comments. We welcome your real estate related comments. Please remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.